Hello, this is Danvi, short for Danji Varasani. Thank you for joining me, and this is the recording that I'm recording now, which I have promised to many of you, and no doubt you've been eagerly waiting for this. It's taken me some time to decide on the best possible approach and the topic and the content. So as you see on the Word document here, we have a question of where from here regarding the financial market on a longer term, possibly say between 18 and 24 months. So it's going to be very interesting and very exciting, and I'm very excited in presenting this material to you, and I'm hoping that it will enable you to refine your own analysis and possibly consider what actions are wise for your personal circumstance. Before I get into that, at the top of the document here, I have outlined or detailed contact details for myself. So if any of you wish to interact with me with some constructive suggestions, criticisms or questions, I will be more than happy to consider them. So you can contact me by email at info@danv-charting.com or tradingchartsforwealth@gmail.com. And currently I'm also in the process of constructing a website which is partially functional, but it will have a lot more details and content available, so keep a note of that for you to visit it in the future. Secondly, a disclaimer, and that you should know that the material that I will be presenting and discussing here is purely for educational purposes only, and it should not be used to interpret as an advice or inducement to buy or sell or trade any financial instruments or even abstain from any action. And as all of you are aware, trading financial instruments of any kind involves very high degree of risk, and you could lose more than you anticipate. You might not get your money back, and consequently you should consult a financial advisor, do your own due diligence, and you should know that I am not regulated by any government agencies under any jurisdictions, so I am not authorized to give any advice. So you should take full responsibility for any action you decide to take or abstain from as a result of material that I am presenting here, and that I will under no circumstance in any case be responsible for any losses that you might sustain as a result of this. So with that now out of the way, let's go back to the question of where to from here for the financial market in a much larger cyclical trend. Not something where we will be looking at where is the market going to be in a week or a day or a month's time, but we are talking about over next 18 to 24 months, maybe even a little bit longer. Now, whenever we consider potential market directions over longer term, there's always a question about whether we should consider fundamentals or technical meaning technical analysis. Which one should have prominence? Well, each of you can make up your own mind regarding this. I have a particular view, and in brief, this is the agenda we will be going through. So we will consider fundamentals, whether they should be given any prominence and to what extent. Is technical analysis effective? And what does it suggest the likely trend will be or market direction over the next 18 to 24 months? And then how can all of this material benefit you? What can you do to plan to benefit from the material that we are discussing? So going back to the first question here, we will consider historical examples of where some fundamental statements by well-respected individuals were made, and briefly consider how the outcome played out. What was the outcome after their statement made, which they made a statement after, I'm sure, considering many factors. So going into the details on that one, let me take you through the material that I came across. And just to point out, in addition to the contact details here, you can follow me on YouTube, where I have posted the last recording, which apparently only posted there recently, but is nearly 2 years old, and that was discussing at the time the likely turn of the market, and where one of the things that I featured was this particular chart, where I was expecting Dow Jones to have a possible top in the region of 16 to 17,000. So we are now in the close proximity of that, if the market has not topped yet, but we could well have topped, and in which case it's very imperative to know what is going to be the likely outcome over the next 18 months, 24. Then secondly, under the Google Plus, you can follow me there for any recordings that I might have presented live, as well as anything else that may be posted in the future. And I also post several number of charts and comment on quite extensively under the TradingView website on my profile page under Danvi. So you're welcome to, if you have not already familiarized yourself with me there, you can visit the TradingView. The basic membership is free, so you're able to access most of the material that I've been posting there for over 2 years now. Some of it good, some of it maybe not so good, but you can be the judge of that. But nevertheless, I'm sure you will find it interesting. So those are places, additional places where you can continue to keep up to date with the things that I'm posting out and interact with me there, in addition to the email addresses on the website that I posted earlier. Okay, so let's go into the first part, where we are looking for historical examples where individuals like representing central banks and other financial institutions have made some comments and how these compared with the outcome. So on this particular website here, we have instances where Greenspan, who was the former chairman of the Fed, made various statements during his time in the office, and I was intrigued by some of them, so I will share them with you, but you can do your own analysis and you'll be able to confirm and clarify. One of the thing here is on the let me just take you to the correct chart here. Okay, so this is the chart of a Dow Jones, where Alan Greenspan is noted as making a statement. This is going back end of 1996, and he made a comment there about market being in irrational exuberance mood, and I think it appeared that on the day that he made that statement and a day or so afterward, market fell very sharply, and then it just continued straight up. So he considered that the market rising from the low back in 1987, having risen this far, was acting like irrational exuberance or the market participants, and therefore he considered, by making that statement, that it was probably overvalued. They were over exuberant about the market. However, as you can see from there, market then carried on for quite a long period after that, and when he made this statement, we were probably close to about 5,800 or not even quite 6,000, 5,800 or 5,600, somewhere in that region, maybe 6,000 at the most. And then market carried on and topped out near 11,000, so almost like 70-80% above where he made that statement, and he never really looked back for a long time for any major setback after his statement there. Secondly, this one particularly intrigued me because I was keenly awaiting confirmation of the market top in 2000, and in particular I think the Nasdaq topped in March, April of that year, whereas Dow Jones made a top at the beginning of 2000, and Nasdaq I think topped about 2-3 months after that. So just as the Nasdaq was topping, he came up with a comment, and the sort of things he made a comment of is because of this technology stocks booming in the way that they did, and how they were overvalued from many traditional perspectives of income multiples and PE ratios and etc. Nevertheless, he was actually very, very positive about it, thinking that all of this technological advance is helping to keep the inflation low, to improve productivity, and in many ways improve financial prospect of the market. And so the comment was that he did not consider at the time that the Nasdaq is going to collapse anytime soon. So in my understanding, that was the conclusion he came to, and he summarized it by saying Nasdaq is not going to collapse anytime soon. So whatever fundamentals he relied on, he made that comment just as Nasdaq was topping, and you can see what happened to Dow Jones, and correspondingly Nasdaq lost much more than what the Dow Jones lost. Nasdaq lost nearly 70-80% of its market valuation, and many of the stocks have never come up to anywhere near where they are or where they were back in 2000, and many of them gone bust. But there was a fundamental assessment by a very capable individual in charge of Fed saying Nasdaq is not going to top anytime soon, and that marked the top of Nasdaq. Similarly, in this same article, it goes on to make comment about in 2004 when the interests were low and subsequently interest rate went up, and he was encouraging the homeowners and the people who were taking out mortgages on domestic homes is to go and take out a mortgage based on ARMs. ARMs is in US they call it a variable adjustable rate mortgage. So if the interest rate were rising, and so one would think that the cost of the borrowing is going to go up, he apparently came up with this. And in US, and many residents in the US will probably know that you have, or you did have at that time, products marketed by many lenders where for the first year or 2 year they give you a mortgage charged at an interest rate which was ridiculously low, almost impossible to even believe, but because it was adjustable, it was going to continue rising. So in the future, after the initial period, maybe say 2 year, a mortgage would then start charging you at a full normal market rate, which would be much, much higher. And so he was encouraging people to take that mortgage on that kind of variable adjustment mechanism where you could get your mortgage at a very high loan to value or very high monetary value at a very manageable mortgage repayment rate on a monthly basis at the outset for a year or 2 year. And so he was really expecting people to take that up. So that's why he came up with this comment. And what happened was that people were encouraged to use that and buy mortgage or buy properties, taking out the mortgage that they really could not afford in any other way. And consequently, what happened, where property prices continue to rise very, very sharply, both in US and in UK and I suspect in many other parts of the world similarly. And this was Alan Greenspan making that comment. So why would somebody in their right mind, knowing that the mortgage rates were very low at 1% and it's going to be rising, expecting, instead of asking or suggesting people take up a fixed rate mortgage, maybe the fixed rate might have been higher than 1% or 2%. I accept that, because as a former financial advisor here in UK, I know very well that anybody taking out a fixed rate of 2-year or 3-year might have paid much higher rate. So maybe then individual couldn't afford to take out a mortgage on a property with a higher rate of mortgage. So that maybe that was the logic behind him asking or suggesting people consider this adjustable rate mortgage. But nevertheless, people took out that, and as the mortgage interest rate continued to rise, and as their adjustable rate mortgage became the initial period came to an end, they were actually paying a mortgage based on the market rate, which was substantially higher, beyond the means of most people or many people to even afford. And hence we had a potential topping in the mortgage market, which then coincided with the topping in the broader equity market. But then his successor, Ben Bernanke, made a comment around the time when the property prices were close to topping out. He made the comment that he was not concerned with the level of debt that the individuals were having to saddle, and he did not consider a much wider implication of some local problems in US would actually spill over into wider US community, wider territory in the US, where some isolated pockets where some of these problems were initially being noted would spread to US wide, and not only US wide, but in fact we know what happened historically, that we've had property prices collapse in the US, many areas experiencing 20%, 30%, 50% and more loss on the capital value of the properties at the peak, and similar mirror reflection of property prices suffering major setback here in UK and in many other parts of the world. Certainly in many European countries we've had property prices suffer major setback. But the point I'm making is that here are individuals very qualified, very knowledgeable, very well equipped by data analysis, and they can call upon any consultants in their country, or even hire people from outside the country. They can commission any research, everything at their disposal. Were making comments where you would think that if you took note of those comments you will be fine. But Alan Greenspan did not help you by making comment on Nasdaq not collapsing anytime soon, then making a comment that people should be taking up this adjustable rate mortgage, then Ben Bernanke making comment that the property price is not going to collapse anytime soon. What are they relying on? So my question is that while the fundamental is very important, and I do not dismiss it by all means, I do not say the fundamental is useless. I think fundamental is very important, but what these are highly isolating or highlighting is that the fundamentals cannot be the only guide, or rather it should not be used as the only guide. There must be something else beyond the fundamentals to enable you to avoid these major catastrophic mistakes. Now people might think, well, okay, these were central banks, they have to keep up the mood of the country, and maybe they have to make these kind of noises, otherwise they would set up a panic. So one could understand that. Or could it be that this was actually betraying their intelligence? Well, I'll let you make a judgment on that. But the other thing also is people in the financial industry, particularly people in the investment world, you would think are better equipped. At least you would think so. because they're in the business of investing, they're in the business of making money for people they're managing money for. So as a young individual back in 1992 for myself, I remember very clearly, and many of you who lived at that time will probably concur with me and confirm that this particular chart is a chart of Nikkei index. And in this Nikkei index, what I'm trying to show, and I don't have a history of this particular chart beyond 1984, can't really tell you why, whether there is no chart price history available or whether the Nikkei index was actually constructed back in 1984. Couldn't tell you why. I've not really gone in to find out the reason why. Suffice to say that is not really relevant. What is relevant is around 1988 and 89 and leading up to 1990, those 2-3 years particularly, and maybe not even 3 years, maybe more importantly 88 and 89, where I was hearing that many large multinational companies in the UK, and I suspect that maybe something similar in US too, people were sending representatives of these companies to go and visit their equivalents in Tokyo, in Japan. The reason for this was that they came out of World War II completely bombed out, and they became a major force in financial investment world to reckon with. They, in fact, during that time, they were number one, and US was number two. So obviously whatever they did must have been right. That was the logic. Fundamentally, they were doing something right, and whatever they did fundamentally supported their genius ideas, and that they were at the forefront of a major breakthrough where they can have very strong economy that is rising exponentially almost, and similarly a very strong currency, yen. Yen had continued to appreciate as a result of a strong economy, because probably everybody wanted to invest in Japanese market. So if people want to invest in Japanese stocks, they have to then buy yen, and hence the yen then would continue to appreciate, because there is more demand for yen, because people want to invest more money in yen denominated instruments. So when we had this significant fall here, this is where I come in, because I was noting this as an individual completely outside the financial industry. I came into the industry and became a junior financial advisor back in 1992, just qualified, and I was still learning from some of the more established and more experienced advisors at that time. So I was very keen to take note of their comments, and I happened to visit or attend an investment conference hosted by investment company called Legal & General Investment. Legal & General is a very well-known worldwide company, and they have an investment arm. So they had major analysts, fundamental analysts and fund managers making an argument that under the normal lessons in basic economy, is that 101 they call it, is that if you have a very strong currency, then the companies who are broadly exporting their services and goods would begin to suffer as they become uncompetitive. And when that happens, their stock market should then experience weakness. That's a normal 101 lesson in economy. And yet here we had a situation where that was not the case. The yen was appreciating and the stock market was going up. So when they had this decline, they thought that was just a correction. So it was in 1992, when they were amidst this correction, they were expecting a major investment opportunity in Japan, because they were expecting this was just a setback, just like we had a setback here. This was just a setback, and the Nikkei index is going to retest its all-time high and it's going to go up. So when all the major representatives of the UK companies were sending their envoys to Japan to learn from Japanese companies what they were doing that was so successful in retaining skill, retaining personnel, and motivating them to become very productive and having very profitable business. So they wanted to learn something from Japanese companies. But then just at the end of 1990, Japan market topped. But when they had this situation here, the legal and general investment fund managers were there. This was just a setback. They were expecting this to continue higher. So they were, broadly speaking, looking to position themselves to gain from Nikkei index rising, and they did not feel that they needed to hedge the weakness of yen because they thought this is going to continue higher. But you can see if they were correct in their analysis, and I would suspect that the very qualified analysts, market technicians, number crunchers, and anything you can care to put together for the might of legal and general to make a correct assessment. But that was the investment conference that I attended, and I was very eagerly looking for confirmation and follow through of that, and it never happened. Never happened ever since. So clearly whatever fundamental they took into picture wasn't quite adequate. So it should not be the only thing that you and I consider. We should consider something different from all of these people who apparently come up with very intelligent analysis, and yet they prove to be catastrophically out of kilter, catastrophically wrong, not only by magnitude but even by time span. So you and I, and certainly I for myself, one, do not have the ability to fundamentally analyze anything, let alone national economy and market cycles. Fundamentally I do not have the experience, know-how, or even inclination to go into fundamental analysis that deeply. But what I do gather is that sometimes fundamental act as a major catalyst for a market turn, just like the analysis that these people were expecting Nikkei index to continue forever up, and it didn't. So they act as a market catalyst for market turn. Sometimes the market is already in a particular directional travel, and some fundamental events or fundamental analysis act as a confirmation and catalyst for a market to continue in that particular trend. So at what time fundamental will act as a market catalyst for market turn, and at what time will the fundamentals act as a catalyst for market to continue in the same direction, propel it in the same direction? Well, I have no idea, and I suspect that many of these capable fundamental analysts will probably struggle to point that out to you. So I would say that, going back to this Word document, I would say that you need to compare the outcome of these people making these fundamental assessments, and it has proved to be grossly incapable of guiding people correctly, and quite frankly in many instances have proved to be completely out of kilter, as I've just said, by both magnitude and by the time factor. So I think we need to consider some other elements. So technical analysis, how effective is it? Is the market random? Is it just a self-fulfilling prophecy? And why is it that if there is any real application to this, why is it that many people scoff at the idea and they dismiss it like it's just a tea leaf reading kind of an exercise? And why should it work when the fundamentals often are not able to identify correct market status or major turns? Why is it that the fundamental the technical analysis should work? So in some way, let me take you through back to some of the things where we can answer that. So is the market random? and is it just a self-fulfilling prophecy? Well, I showed this particular chart very briefly to you before. This is the chart that, with my understanding and application of technical analysis, I made this one back in September. In fact, on this point there is no particular chart actual number, but you can see here, look, 16th of September 2012 is when I actually made a screenshot of this particular chart about Dow Jones, suggesting that we would top out around 16,000 to 17,000. Nothing complicated, just a basic megaphone geometrical pattern using Fibonacci of this particular swing, identifying that mark to be here. Similarly, you go to Fibonacci of this one, projection marking the bottom, but then the reverse projection giving me again confluence of Fib, and then using this internal swings of this particular cycle from the low, and basic trend lines, etc. RSI here, you have a bearish trend line marking the top or the momentum leading up to the 2000 top, and then the momentum high, but the bearish momentum on the RSI coming into play closer to the time when we touch 17,000 area. By basic time symmetry, I was expecting it to end by 2013. Subsequently, I have updated this particular chart, and my analysis suggested that the upside target remained the same, but instead of being back end and early 2014, I am now looking for mid-year or July 2014, and in fact I think the market has topped, but that for a little later on. But nevertheless, just using this was telling me that we are looking for a time window sometime in 2014 for the major turn. And in my sort of eagerness, I drew an arrow suggesting we're going to drop all the way there. Well, we're not going to go there in a straight line. Neither are we going to go straight to this kind of level. Chances are we might drop, we might come to this area here, we might bounce back very strongly and then drop. I couldn't tell you just I have some ideas, but based on this particular chart, that was not the comment or a view that I was trying to form. My view was at that time is to isolate a potential area, both in terms of the magnitude or level where we are going to expect a turn, and possibly a time window. So there was no reason to remain bearish anywhere along from the time that I produced this chart back in September 2012 until we reached the 17,000, and earliest time would have been 2013, and then subsequent updated charts suggest that July 2014 is probably the area. So does technical analysis work? Well, this chart seemed to suggest that it worked. So market cannot from that perspective be random. Likewise, on this other chart that we were looking at, I have that last swing starting from the low here in 2011, a minor trend line going up. Well, if somebody was to look at this, they'll see that when the market came and touched it again, so 3 times it had continued to remain as a support. So the logic would be is that as long as the support remains in place, we are going to continue higher. When that particular trend line breaches, then the reasoning would be is this particular trend that has been in existence since the low in 2011 is now over, so at least we will be making some kind of retracement. So even if we just came back to support what was previously resistance now becomes support, then we expect a minor retracement, and then market will continue higher, or that we would breach that and then the market is in real trouble because it could come back to retest these major lows here in due course. So if the market was completely random, why would it be so clearly defined? I do understand that market is random in a sense that from day to day you don't really know whether it's going to go up or it's going to go down, and if up or down by how many points. So in that respect, I do understand it does have some element of randomness in it, but that randomness is only like a when you see, for example, on a seaside, various ripples come up, they look random, they look unrelated to each other. However, whenever these ones begin to get amalgamated into a larger wave, then this larger wave becomes significant, then they turn into a major wave. And even if those individual waves appear to be random, there is no randomness. People know that there is some unrest in the where the seawater is behaving. Either is brewing up for a storm, or a major tide is coming into it. So in similar logical way, the market from day to day and week to week might appear apparently random, but they're only random, or they appear random at a very small degree, because from day to day nobody really knows, is it going to go up, is it going to go down. But once you begin to sort of crystallize it and begin to frame it in a broader picture, then it's no longer random. For example, this is a log chart of Dow Jones. If you simply just drew a trend line here in the same way, you came back here, for example, and drew a trend line there like that, you can see the major low of 87. So you could have drawn a trend line there, and as long as that trend line continues to remain in place, which for a short while breached here, but then it regained that, it just carried on. Whenever it breached it again, that was significant breach, and then we had a major setback, and then that particular trend, whatever it was, is now completely over. So while the market continued higher and maintained that trend line, it was not random. There was nothing randomness about it. So any fundamental analysis might have either confirmed or probably proved ineffective of identifying where this market is headed, because during this time I witnessed this 87 crash, and in UK there was a local storm. We had a major storm where many old trees were blown down, and the market collapsed in the way that it did. It lost massive amount within a week. Whether that was random or not, whether that should have then continued to wreak havoc and the prices could have gone a lot lower, I couldn't tell you. But from the chart it appears probably not random. Market continued then progressively to regain and continued higher, almost up till the top in 2000. So what was the fundamental that brought it down? What was the fundamental that pushed it up? Well, you can go back in history and probably try and coin these things together and maybe identify why fundamentals suggested that there was a top there, why the fundamentals then suggested that we should only have 2 or 3 months of decline, but very severe, and why the fundamental should re-exert and the market should continue higher. I think the fundamental is incapable really to highlight those things to you. But maybe in a larger scheme of things, fundamental probably would have said, okay, well, we were coming out of major recession back in 1980, and we were very early in a bullish cycle, and basic regaining advantage of many industrial revolution, internet coming on board, many new inventions of that sort, then broadly speaking, compounded to or propel the market this high. Well, that may be so, but something is not right, because if this market was so random and market was more governed by fundamentals, then I think the fundamental failed to explain to me why we've had this major setback at the time that we did, why the major setback were only limited by 2 or 3 months. Why is fundamental able to flick switch so sensitively, and why was fundamental not able to identify this mega 2000 top? Even Bernanke, or rather Alan Greenspan, got it wrong. But just like the trend line, I am going to put this trend channel up for you. Right, so I know I'm doing this with a hindsight, so I can understand that maybe why people might think, well, anybody can do this with hindsight. But you know what I'm doing here is nothing new. Anybody can do this on any chart, absolutely. Okay, so why was it that the fundamental, caused the market to collapse like this? Why was it the fundamental then allowed the market to continue right up to the top, where this particular trend line to the bottom has provided support, very significant support at that, each time the market came to it? And why was this top made there exactly when the market touched the top? Is that randomness, or would you say that there is something more than just randomness? Why would fundamentals say that the market will top exactly when it gets back to the previous high within this channel? And why would the fundamental flick the switch so that the fundamental would change and eventually market will come down and be supported, but then this time it didn't have the same level of support, so it only sort of retraced, only to come down, breach below, come back here, retest, suffer, and then it never really regained that. If you look at it, that particular magnitude, or the what you call dynamic, was never really recovered. Subsequently, we have continued higher. We have lacked the momentum of the market there. Whatever economical advances and fundamental advances and everything else that you look at, this trend line was left when we breached below that. Subsequently retested it, we broke below that, we are attempting to come back up, but then all of these advances is now very weak in comparison to what went on here. Okay, so my suggestion is that you take into account more than just fundamental. Technical analysis appears to be working. I can go into greater depth to explain that, but suffice to say that just looking at the basic trend line, basic channel, suggests to me that the market is not necessarily random, no matter how random it might appear from day to day or week to week. In broader scheme of things, it is not random. And just like the Dow chart that I posted here, suggesting a top around 17,000, and likewise as illustrated by this here, you can at least consider that the technical analysis is effective and the market is not exactly random. There is some logic behind it. So why do is it a self-fulfilling prophecy? I don't think it is, because if it was self-fulfilling prophecy, then one would reason and say self-fulfilling prophecy, each time market comes down to the basic baseline as a support line, it is supported, so it goes up. So it comes down, supported, goes up, come down, supported. So really self-fulfilling prophecy mean that everybody would be just buying the market every time it dropped back to the basic support. So it continued to do that right up till here, but then whoever bought here for some reason didn't want to continue buying the market all the way back to the trend line. So something changed here. And what changed that? Was it fundamental? And it's not even September 11th event, because September 11th event actually happened just before we made that bottom. So in fact we were very close to making that bottom. September 11th event happened actually over here, 2002, September 2002, right? So September 11th event did not actually change anything. It actually, September 11th event, what it did do is actually act as a catalyst for like a capitulation selling, and actually made a significant bottom soon after, right? So that's where the September 11th event happened. And many people think that, it was September 11th event actually changed the course of history. Well, September 11th event actually happened just as the market was close to forming the bottom, where actually then the bottom was formed. But all of this weakness happened long before September 11th event. And Alan Greenspan, making this rational exuberance, allowed the market to continue higher, whereas from that point of view he should have continued to tighten the interest rate, but then he did not do that. What he did is he allowed the market to go all the way up to here. Just when he then said market is not going to collapse anytime soon, he was now in a phase of tightening the interest rate, and interest rate started rising, and I think that fundamentally was probably what caused the market weakness, which led up to here. But let's not get entangled in that, but just identify this. What I've shown you here is not random, and that it is not even self-fulfilling prophecy. For example, it's not unknown for many people to possibly apply a basic moving average, and I will just put two up for you. Moving averages, just a normal moving average, nothing complicated. So one moving average and another moving average, two moving averages. One of them we will say is a very long-term moving average. So that long-term moving average, for example, we will have 100, and the other one we will put it for 50 rather. We'll put the other one at 200. Remember, this is a monthly chart. So now 200, and the style for that one, we will make that one look brown color. Okay, so is it self-fulfilling prophecy? Well, the broad trend line that I applied here on a log scale, you got 50 period moving average apparently supported the market here, supported market there, and here it acted like a temporary support. Market fell down, came back, retested it, couldn't really get much above that, and it collapsed below. Then it came back and it effectively oscillated on either side of the 50. It's the very first time since leaving back here in 1982-83 that market ever visited the 200 period moving average, and it appeared as though it was a temporary breach. Is recovered. So what you gonna do? So the point I'm making is, while I know what these technicals are suggesting to me, is not exactly what you might call self-fulfilling prophecy, because self-fulfilling prophecy says market is rising on the 50, so it should continue rising on the 50. Well, it didn't. It failed here. So if it failed here, then it retested it from it sort of retested, it fell down. Then the idea is that the self-fulfilling prophecy, so once the 50 period moving average appeared as the resistance, it should each time appear as a resistance. Well, it didn't here. It actually went back up above, went up to a point, and then came back down again, oscillated on either side. So self-fulfilling prophecy would have said it should continue to act as a resistance, should have failed market here, and the market should have fallen down. So it's not self-fulfilling prophecy. So there is more to interpretation than just saying that there is a self-fulfilling prophecy. So we can dismiss that. So why if there is not a self-fulfilling prophecy and there is not a randomness and there is technical analysis do have some credibility to it, why is it some scoff at the idea? Why do they some dismiss it by saying it's simply a tea leaf reading? Well, one of the reasons why they say that is because I think lack of knowledge, lack of experience, and many times the market is at odd, because technical analysis suggests one thing. For example, over here a technical analyst would have clearly identified this as a potential area for market to experience significant problem, and yet the fundamentals was saying everything was rosy, like right at the top. The very fact that the market has risen to the top is because all during this progression all the fundamentals were pointing skyward. So fundamental analysts would have said this market is going to continue higher. Hence Alan Greenspan made a comment, Nasdaq not going to collapse anytime soon, because everything he was looking at that time fundamentally was pointing to north. So as an analyst, if he paid too heavy credence to what was fundamental picture, he would have been at 100 or 80 degrees diametrically opposite, because the technical analysis was suggesting market is going to experience a significant weakness. If nothing more, it would have expected some kind of a significant retracement, possibly partway through this channel, or maybe like over here in 98, or possibly all the way back to the base channel, but expecting a significant setback. Likewise, when Ben Bernanke made a comment about property prices not collapsing anytime soon, and that he's not worried about the debt and all this kind of thing, technical analysts would have identified this area as a potential area for major weakness. And yet it was almost seemingly 180% or 180 degrees diametrically opposing the fundamental picture. Just like now, everything now is suggesting that the market is going to continue higher. And if you don't believe me, just look at another particular article I have. This particular article here is talking about 6 ideas powering Aviva. Aviva is another institution in UK who is a major insurance company, but they also have a major investment arm, and they are talking about this GARS. What GARS is another institution called Standard Life. They have a fund which has been very, very successful, and many investment advisors have been investing client money in that particular fund. Is called Global, G for Global, Absolute, A is absolute, so Global Absolute Return Strategy. So that's a strategy which the Standard Life investment fund managers came up with. Very clever idea, in fact, using methods which was not very common at the time, and has proved very, very successful. But I would just caution, they proved very, very successful when we've had market rising like that. But that doesn't detract from their ability, because they have really produced kind of results which other fund managers have struggled, because they have all been rising on this bullish trend. But this investment Standard Life investment managers running this particular fund came up with an idea which apparently has produced excellent results. So nothing to detract from their success. However, one of the team member who was working on that team have left, and in fact quite a few people have left that particular team. Some have come to Aviva, others have gone to Legal & General that I mentioned earlier, and some have left and gone to another company called Jupiter, an Invesco Perpetual. So the team that spearheaded this very successful strategy with Standard Life have apparently now separated, and some key members have found their host in other institutions, and one of them has come across to Aviva, and they are now looking at having an alternative, like a competitor, a challenger to this original idea with Standard Life. And the point I'm making is this, and I will come back to this particular, once I identify this, I'm going to come back to that in a moment, because we're going to look at that in a bit more detail. So they are talking about 6 different ideas, and one of the idea they're looking at is European Central Bank is going to set up a major stimulus measure. So whatever it is that caused them to come to that conclusion, this is their conclusion. Fundamental conclusion is that the ECB is going to come up with a quantitative easing of its own. I have no idea whether they're right or wrong, but this is one of their basic idea. So based on that, they will be trying to capitalize by positioning themselves to benefit from quantitative easing of ECB, which would support many small companies and smaller economies in the European Union to become very profitable and have a lot of positive contribution to the fund management. So this is one of the things they're going to be looking at. Inflation is going to be kept low, and etc. The other one is Abenomic is a success. Is it a success? Well, here look, it is saying that they have already acted very aggressively in easing this their monetary conditions, quantitative easing equivalent to quantitative easing of US. So they've come up with this very aggressively, and it has worked, and it's been supportive of Japanese equities. The conclusion is that this is going to continue because it's not over yet. So Japanese equities are going to benefit from this. They reckon the correction is reasonable entry point for some further further investment. Just like the Legal & General were looking at Nikkei index that I was show over here. They were looking at Nikkei index when this setback was just a setback, offering excellent opportunity to go long. So this time around, apparently this very successful team member who has come across from this team that was managing their money with the Standard Life has come across and is now establishing a challenging team to rival the successful strategies they implemented at Standard Life, and he is assessing that the Japanese setback is only a setback, is giving them an excellent entry point for some further investment. So keep that in mind. I'm going to major on this one. I'm not going to comment too much about ECB, but I'm going to major on that one. And likewise, volatility is very low, which I agree is very low, and mean to reversion, meaning that if we're so low, we're going to now have a period of high volatility where we will have really significant change in market status, which has been very, very stable recently. But this is another view. They think the US dollar is undervalued, and improving US economy prospect mean that US market is going to continue higher. So out of these are people who are paid massive amount of money. They are managing billions of dollars of people's wealth, are making this kind of comment. So if now I came up and suggested that these ideas are going to be disappointing, then these people managing these people's huge amount of money, they are not going to agree with that. They are going to dismiss this as simply a tea leaf reading. Now I know there are many people in the past have made predictions, but I can't tell you what led to those particular predictions, and I'm not saying that any technical analyst making prediction, including myself, would never get it wrong. But what I would say is that if people made some bold statements like we are going to see Dow Jones racing up to 30,000, and there are many technical analysts actually doing that now, and likewise many technical analysts might be making some different claims, opposite claims. I don't know where they come from, what is the basis, but from my particular experience I could say that I can only talk about my approach, and in some way my approach is very similar to many of them, but in some way it's different because I have a different perception, different approach, whereby I take into account different dynamics, not just simply one particular chart. So I bring everything else together that I know about and I have learned since 1992 onward, both in terms of experiencing the investment market since 1992, having worked in the financial services industry in UK, and likewise also developing my charting skills since 1992 and have honed these significantly leading up to 2000, and subsequently I have continued to improve, and I feel that my analysis now are really high quality, longer term pictures, which I think could enable individual to take advantage of, because those are the big cycle changes are the ones that allow people to make significant amount of money by having positioning themselves correctly, or at least avoid the worst of losing the capital value of the investment. But anyway, you can make up that particular assessment and make up your own mind. But I think when people have made these things, one, they probably never revisited and come back and review. Secondly, their approach might be wrong. So if people simply look at that, certainly these fundamental analysts and fund managers, if they look at technical analysis, and if I start saying that the ones who are talking about this Abenomic is going to continue higher, and I turn around and say they are going to be wrong and very disappointed. Likewise, if they're making claims like US dollar is undervalued and because of the improving economy in the US is going to be going up, and I make counter claims, naturally those people are going to scoff at it. Naturally they will dismiss it like it's a tea leaf reading. But I would say that if the technical analysis is based on some real logic, then it would not stand to their assessment of it simply being a tea leaf reading. So why should it work? Well, why it should work, because, and this is entirely my reasoning, I think that many people like these fund managers, they come up with these kind of comments because naturally they're having to make this bold claim. Reason why is because they're trying to establish this fund, right? And it's a fund that's going to rival this previous very successful fund. So naturally they have to come up and make up some bold claims, otherwise people wouldn't, pay any attention to them. And I can tell you that they are already, this fund is established and it's running, and that they have already attracted a lot of financial advisors' attentions, and many financial advisors have actually started putting money into that fund. So they have to make these kind of claims. But are they correct or not? I think that these are vocal individuals who have made the claims, and likewise many people who publish, and including myself who are publishing view, are vocal. But there are many analysts, traders and institutions who have high power investment teams or analysts, or huge amount of money to actually influence the market by the things that they do, cause the market to either stop or turn, or simply those people withdrawing their support will cause the market to turn or change. What I mean by that is these people have a lot of clever individuals who might have even unheard of approach of analyzing, crunching numbers and doing whole host of calculations to come up and put a fair value on the market. And these individuals are not necessarily looking to pick the absolute top and bottom, but what they are doing is that they will be avoiding the major turn of the market against them, and they in fact will be looking to capitalize on that. So the reason why it works is because these people are spending such a massive resources in assessing the market and in deciding exactly which way the market is going, and then the net result of this is they're taking the positions. So end of the day, end of the week, end of the month, end of the year, the closing prices is actually the final result of everybody's opinion and everybody's ability to analyze and express this in the market. So it's a net result. So if that is the case, then somebody like me who is lazy, probably incapable of even fathoming some of these weird and wonderful way of analyzing the market and even understanding the fundamental aspect of this, can begin to start graphing them, charting them, and putting them into perspective on a chart. And that's why I think the charts work. It works not because chartists are able to draw the lines. I think it works because of all these major market participants, some vocal like these individuals, and somebody like me who publishes chart are vocal element, but there are many strong elements which are non-vocal, and they are very clever, and they have capability of capitalizing on their assessment and expressing that in their trading, which then results in a price either moving up or down, making high or low, closing where it closes. So when I approach the market, I think I am capitalizing on all of them, expressing their view, expressing their opinion by taking the market positions, either exiting or entering, and the net result is expressed in the chart. So if now you approach the chart applying correctly the technical analysis, you are benefiting from everybody's ability to analyze the fundamental aspect or even technical analysis, and the net result is where the price is. So net result of everybody's opinion, everybody's analysis is expressed in where the market is now. And I am considering that the market is very vulnerable, is likely to correct from here. That is a net result of my analysis and view of taking everything into account. So I will now be looking for some element to confirm what I am expecting. If I am wrong, then I will not be wrong for too long. I will review and I will correct myself. I will not be wrong for 2-3 years, for example. I will only be wrong for a small period of time. And I don't think that looking at a much larger time frame monthly chart, that being out by 2-3 months necessarily, and even 10-15% of the market necessarily, mean that you're wrong. But just like people who exited the market here, or didn't exit there but exited the market a bit further down, they were still not wrong. Likewise, if I was saying the market is now potentially creating a major top, and market then continues higher for next 2-3 months, doesn't mean that my analysis is wrong. I am looking for evidence of market to break down, or my other approach suggests the market is now topped, which I think it has. So if I'm wrong, I will not be wrong for too long. That's where the technical analysis actually have an advantage. There are many market analysts and fund managers have been, bearish while the market has been moving up. And Hugh Henry is another fund manager who has been very bearish for a long time, and he's only recently, in the last 6 months, probably last 7-8 months, have thrown in the towel and have now considered that maybe the market is in a bullish mood. So you wouldn't be wrong for that long. That's basically what I'm trying to say. That's why technical analysis have an edge, and that's why what I think the technical analysis work. So we've gone into just over an hour. So my main point of the whole of this is, where are we in terms of where the market is for financial market, and where it's going to go, and I'm going to use Nikkei index and Japanese yen, because that means we are going to revisit the claim by this very capable fund manager saying that that's Abenomics is going to work magic, and that this setback that Nikkei index has suffered so far is creating a major opportunity for reinvestment. And I think I am at 180 degrees opposite to their view. I don't have the same resources. I don't have the same resources both in terms of education, knowledge, data, and other resources that I could draw upon for my analysis, other than the charts that I'm sharing with you. But I am diametrically 180 degrees diametrically opposite to the analysis of this particular fund managers, thinking that this is creating a major turning point, major entry point for a bullish move for Nikkei index, for them to invest their money. They've got a lot more to come, they think. Well, let me take you back to the chart of Nikkei index. As I said, we don't have the same resources even in terms of charting. So I then took up this chart from Yahoo, and this chart was picked up back in August of 2013. You can see the date here, 23rd of August 2000. This is 2007. Sorry, it is 2013. I think it's 7/28. Okay, so it's 2013 quite clearly. 23rd of August 2013. I took up this chart screenshot, and the reason why I did this is because all of the charting that I have seen never has all of this price on it. And many of you who know me will know that in addition to the common technical analysis, like I've just shown you briefly by charting trend channels and trend lines and Fibonacci's and other things, that I also am keen Elliott wave technician, Elliott wave analyst, and wherever there is clear picture, Elliott wave has preeminence in my charting. In fact, once I begin to analyze a chart, initially I would try and see if I can see a clear Elliott wave pattern, and then I would pivot all my analysis based on that. If I do not have adequate price history to actually form concise view based on Elliott wave, then I will for time being look at general standard technical analysis, and then within that I will try and see what Elliott wave analysis is suggesting, but then technical analysis is kept in the background. So when I took this chart, I was trying to think that I remember history where people were going to Japan to try and learn from Japanese economy, and just when they were going there and they were coming back with glowing reports about how they look after their employees from cradle to grave, and how they never let a struggling company go bankrupt, and all of this. And of course, during that time I didn't understand the significance of this, but looking with hindsight, looking back with my understanding and experience now, what a prediction is. Those things were happening and everybody were congratulating Japanese economy and Japanese finance ministers or whoever were responsible for Japanese economy at the time, and it made the top exactly on the eve of 1990. And in fact, in Japanese market, December of the year, not every year, but December of the year is a significant turning point. So just keep that in back of your mind. But when I took this chart, I said, okay, what Elliott wave analysis is telling me about Japanese market since then. So I'm not so much interested in there, but I think what has happened is this top in 1990 was generational top. So in some cycle degree, that was a major wave 5. It's a generational wave 5 being topped. So what we've been now doing is we have now, you can see over this low, come back to the vicinity and even come lower than the low we had here back in 1984. That means that if you were following Japanese economy from when it was bombed out in Second World War, and if we started from zero then to lead up to the top here, then we would have had a clear major generational wave 5 which ended, and we are now retracing some of that. And possibly this here was the wave 4 of that cycle up. So wave 4 then had this as a wave 5. So if you go back and you look at it, maybe small wave 1, small wave 2, small wave 3, small 4, and then this small wave 5 making a massive generational wave 5. But that's not the point I'm trying to make. And what I'm trying to make a point is, after taking this chart, I then applied my Elliott wave knowledge, and I do freehand drawing line. And you can see here that we have a very sharp decline. This first decline was the time when the legal and general investment managers were looking at a major opportunity to go long in Japan, but unknown to them, we formed a major generational top. We had a wave 1 decline in Elliott wave. Wave 1 is an initial decline. We retraced in a wave 2. We came down on a wave 3. We then retraced in a wave 4, and we came down to form a wave 5. So that 5 wave down identified by this declining trend line. So as long as that trend line was in motion, we were in that same cycle degree which ended here. So I'm making that like a capital wave A. So that the 5 wave cycle degree decline was a wave A. Then we went into this messy sideways chop that lasted for many years, and my price history on a chart only takes me back to here. This wave B I put in there is actually put in the wrong place. It should have been here at the top of 2000 top. That's where it should have been. So if I was now labeling this, I would have said that this is the big wave A. Then we had minor A, minor B, minor C to give me a larger degree wave A in parenthesis. Then we've had a decline of wave, let me take a step back. That would have been wave A in parenthesis, wave A here. Then we would have had a minor A, minor B, minor C to give me minor B, and then this rising up here to give me minor C. So all in all, that B, that big capital B, should have been at the top of 2000 high. So since then, you can see I tried to sketch out a kind of a declining trend line, but this one declining, but is not declining as steeply as the top. In other words, it's creating like a converging pattern. So how does that actually end up? So what I think we're having here is this trend line will continue to remain in place, and this bottom trend line, but is not declining as steeply, is also going to continue in place, and we'll finish up with what looks like in the Elliott wave is a contracting ending diagonal, and that would be classic wave A, wave B, and wave C, big capital wave C somewhere here. It would form this ending diagonal. An ending diagonal would have a wave 1, wave 2, wave 3 coming into region here, which is approximately where we are now, wave 4, and we will be going down in wave 5 to retest the low, or the retest this declining trend line. And based on this back in August, I then made this particular chart on MetaTrader 4. So you can see that this high is a wave, this high here was a wave high in 2000. So that would have been capital wave B. So just go back to this chart here. This capital wave B would have been at high of 2000. So this was a high of 2000, and after immediately this chart being in 23rd of August 2013, as I say, I then made this chart. So this chart is a price action up till August 2013, which is what I was expecting, is the wave 1 we had from the high of 2000, we retraced to form a wave 2, we come down here at the low in 2007, wave 3, we went back up with a view that we will be looking for a top. Remember, this price hadn't made a top yet. I was expecting a wave 4 to be around about 16,000 area approximately, and in fact, based on the Fibonacci that you can apply yourself, I was expecting a retracement of something in the region of 78.6 retracement, which is saying here 15,873. So around 15,000 to 16,000 area is where I was expecting a top to form. So is the market random, or does it have some orderliness? Well, based on my chart, that's what I was expecting, not based on fundamental at all, just simply on chart. I was expecting a top to form, and based on that, I am expecting also this decline to make a wave 5, which would at least retest the low we had back here, maybe make a new lower low somewhere in the region of wherever that low was. I think that was the 6,600 something. So we could come into an area of 6,000, or maybe even below 6,000. But certainly we are looking for a major decline once we form this top. So based on the analysis of this chart, then my freehand sketch of this one, this was the result. So this is a screenshot of my chart that I took out. You can see here 10th of November 1923, 2013 is when I formed this chart. So in terms of exactly where we are now, and in fact based on that, I also then posted this two chart on TradingView. This one was 8 months ago, expecting US dollar yen to top out somewhere in the region of 400, 104 rather, to 105 area, and we were still making our way up. On this final leg up, I was expecting we were forming a minor wave 4 and we had to go up. So somewhere in the region of 104, 105 is where I was expecting a top to form. I posted that chart well before we ever got there, 8 months ago, and then once we formed the top, I then reposted this chart. You can see where it actually formed the top in the area of 105 somewhere. So when I was posting that chart, we were approximately here. This was around about back end of 2013 when I posted that chart. We still had some way to go to complete this final leg up. Once we formed that, when I posted this chart, this is where we were. Okay, so this chart was posted 3 months ago from now, and the previous one was posted 8 months ago. So both of those charts are suggesting that US dollar yen is going to top there, and we are going to have a substantial decline. So far, based on this chart having formed the top, we are expecting a decline. Here, admittedly, since I posted the chart, we've gone sideways for quite a while, but I'm still expecting that to break to the downside. And the reason why I'm saying this is because just like the Japanese yen, sorry, the Nikkei index that I was talking about, the US dollar yen is closely correlated to Nikkei index. So using the Nikkei index as a pivot, we can also project where the Japanese yen is going to go. Japanese yen could come partial way, could retrace at least somewhere in the region of like 90, 91 or 90 area minimum. But more likely, if this chart is any guide, this one, I expect Japanese yen to also go back to the bottom end of the range. If not, it will come very close to the overall rise it has experienced so far. So it went up from here, so I would expect it to come close to that, as I said, 90, but certainly probably even lower, maybe somewhere almost up to 85. That this low here was made around 84, so 85 area is possible, but if not, it will come all the way down. Whichever way, whether it comes all the way down or not, or around about 85, there is a substantial trading opportunity for a major cycle trend to happen. But the Japanese yen is like a cross reference because it has a very close correlation to Nikkei index. But Nikkei index is giving me this unique perspective into Elliott wave, is that we've done this decline as a wave A, we've done this messy typical of wave B, and we are now going into what looks like to me in my mind's eye, this is what I am anticipating. So I'm probably jumping the gun, but from what I see, the picture is partially revealed up to the high. So based on that, I was able to now project where I think the Elliott wave is telling me where we're going to go. And I'm not expecting this market to just simply have a setback and continue higher. I'm not expecting that. It is not likely to happen. The other important thing also is that, see the decline that we've seen here, see the decline we have seen here is quite different from the market bounce so far, no matter how impressive this bounce has been since the time when the Japanese came out with the equivalent of QE, which in fact QE didn't happen at the bottom. As I say, sometimes QE or the fundamentals sometimes happen at a turning point. They act like a catalyst for the market to turn. Sometimes they happen in between the trend, where they act like a giving the further impetus for a market to continue in direction. So when recent Abenomics came up and they said they're going to do this to bring the inflation up, to raise the inflation and to reflate the Japanese economy, they come up somewhere in the middle, and since then you can see we had this. In fact, when it came, I believe the Nikkei index was in the region of about 10-11,000, and he made a comment that by July he wanted Nikkei index in the region of 14-15,000 area. So that was almost like a giveaway, in a sense that he was expecting Nikkei index to raise up that much within the space of 5-6 months. So he was pumping up the market. So in fact it acted like a gift. So if people took note of that, and they, once we had a break up above this recent resistance, that was like a gift, where market was going to go up by another 15 to 20% above where the market was when he made that announcement. So it acted like a catalyst for the market to continue and gather momentum. But regardless of whatever they're doing, just like whatever the Fed is doing, and the market is going to do what it needs to do, whatever the Japanese finance ministers or government is doing, the market is going to be very disappointing. And those people who are using their fundamental analysis to reinvest in Japanese market, acting the setback we've had so far, they're expecting that to be simply a retracement and the market to continue higher. I think they're going to be in a disappointment, because the very nature of this downtrend, down legs are very impulsive. The rising market has taken longer, and it's taken, the sketch of the price action is more like retracement, and hence another reason why we'll get a very impulsive move to the downside for Nikkei index. Now, if that happens, what does that mean by implication to other markets? Well, let me take you to Nikkei index chart, and what I was going to show was this chart here. So on this chart, where we have put the capital wave A and capital wave B correctly, so you can see now we've carved out wave 1, wave 2, wave 3, we're going into wave 4, and then we'll be coming down to wave 5. And just like the previous chart that I shared with you, where I was making a guess of where thing is going to top out and how long it's going to take, so this one to some degree is a guesswork. I know where we have a top. That's not the guesswork. The guesswork is now on how the market is going to decline. So if you interpret this decline as a 2 swing, it's not quite clear. If you decline like a 3 swing, rather, that's 1, 2, and 3, and likewise here a sort of 1, 2, and 3, then I'm expecting this to come down in 1, 2, and 3 form. Whether the 1, 2, and 3 mean one come down much deeper, small retracement, another small leg like we had over here, or whether we have 1, 2, and 3 more like here with the middle part being in middle of the range, or whether we'll get a small leg down, retracement, and then collapse. It doesn't really matter at this point. What does matter is that I'm expecting Dow Jones, the Nikkei index rather, to go and revisit the low of 2008, 2009, and maybe even make a new low, possibly around 6,000 or below 6,000. So how long is going to last? So my attempt is, now you can see here, measuring from the low of this low back in 1993 as a capital wave A up to this high, it was approximately 91 bars on my chart, which is the monthly chart, 91 bars. So if I place the 91 bars in exactly the same way, then I was coming somewhere, why didn't I, okay, leave it, just keep that in back of your mind. But then what I did is I measured from the low to the low, that was about 74 bars. Okay, I also measured from there to here, and you can see that 91 bars, okay, that's no good, because that is actually measuring the same thing as what I was measuring over here. Okay, so keep these 91 bars in the mind. These 74 bars, from the low to low is 74 bars, and then what I did is I measured, so both of these 74 bars and 91 bars are just something to keep in mind. Then what I did is I measured from the high to this high, that was 81 bars. Okay, so then I placed the 81 bar from the high to here, which brings us to somewhere about August 2014. So that's my first marker. Then what I did is I measured from the low to the low is 66 bars. So if I do the same again from the low to wherever it is, 66 bars, that comes in a close proximity of where with these 86 bars were coming. Okay, so that one came around March. So around March to August 2014 is a window. Okay, not to say that's exactly where the high is going to be or the low is going to be, but that's a window, that's a time period where I'm going to be very interested. But likewise, if you also note that I measured this 103 bars, what this 103 bars is measuring is 103 bars from a high coming to here, which is the low. Okay, a low in this area, low. So 103 bars from a high to a low, measured from low to wherever, 103 bars brings me to middle of 2017. So based on this, now what I'm beginning to build my picture up is that there is definitely a symmetry of 66 bars, because we've just confirmed that 66 bars from a low to a low, measuring from a low to a high, 66 bars. And because it's monthly, you can allow a month or two on either side, right? So 66 bars have a time symmetry. 86 bars could also have a time symmetry in the sense that we measured from a high to a high 86 bars, likewise measuring from a high to a high 86 bars. So we made a high here. I think the real high actually took place in April of 2000 and December 2013. That's where the real high was made. But also there is a lesser, like a lesser high made in the region where those time symmetry is measuring up. And previously, I remember I said the Nikkei index topped just below 40,000 back in 1990, and it was December. This also is a December. 2013 is a December. And if you go back and check some of the significant highs, you'll find they happen either at the middle of the year or toward the end of the year. See, look, this one here is toward the end of the year, 2000. This one is the middle. We know the major high took place at the end of the year. This one also took place at the end of the year. This high here took place in middle of the year. So middle of the year and end of the year for Nikkei index is significant. So I think based on that we are potentially at a topping end, and we are now, I think we have already topped here in December 2013. But the time symmetry we just plotted showed me that this area is very significant. And I'm now, if follow that, I'm now expecting maybe 103 bar measurement, which is measuring from a high to a low, could also have a significance in the sense that it will be from a low to a low. Because time symmetry is not exactly always high to high. Sometimes it is, sometimes it alternates. Sometimes it is from high to a high. On the alternate, it will measure from high to a low. So in this case, I think it's going to alternate. So we'll be looking for some confluence. So at this moment in time, I'm expecting possibly middle of 2017. So between now and then is where we are going to be expecting low. So basically looking at 18 to 24 months is where I am heading for. So using this time symmetry, using my Elliott wave understanding of possibly a contracting falling wedge, which is an ending diagonal in Elliott wave terms, and Elliott wave terms allow these three swings. So 1, 2 and 3 swings. Likewise, in fact, this one turns out to be what they call 3, 3, 3, 3, 3, meaning every swing of the triangle is 3 swings. So this one coming down is 3 swings, going up is also 3 swings, coming down is 3, going up is 3. So maybe looking back is a 3. So that's basically what I'm looking for. So is market random? I don't think so. Is it technically, does it work? Yes, it does. And it's not a tea leaf reading. There is a lot of analysis that goes in. High degree of technical analysis and knowledge and experience goes into this, and then possibly it can light the way, and it can suggest something that apparently fundamental does not agree with, because everything at the moment fundamentally is very strong. Just like the fund managers are talking about, what the Japanese ministers have done is going to continue. Likewise, US economy is recovering and is going to continue. So is the UK economy is recovering and is going to continue. So everything you look at looks rosy, and everything actually looks absolutely rosy at the very top of the market, and it must do, because it's that rosiness that has actually driven the market there, right? But as technical analysis suggests that could be 180 degrees diametrically opposite to where the market is going to go. And many people might already know, and many technical analysis analysts also would know, is that technical analysis or technical analysis, i.e. market, actually anticipates a major fundamental events in the form of fundamental observations in the economy. So in brief, what it means is that sometimes the market predicts the top 6 months, 8 months to maybe even a year ahead of time before the weaknesses are actually observed in the real economy. So if this particular Nikkei index is suggesting we have topped and we're going to be declining, that means the economy is going to be declining. That means the Nikkei index has already pointed out that in December the index has topped. So maybe 6 months down the line from December 2013, we are already 8 months down. So it's predicted the economy to decline 8 months ahead if we begin to see economy weakening. But if we don't see economy weakening, we might see economy weakening in real economy maybe in another 3 or 4 or 5 months time. That means it's almost 12 months ahead of time. Nikkei index has said it's topped and the economy is going to be now faltering, and we will begin to see evidence of that in real economy reflected by fundamental observations that the economy is weakening maybe 12 months ahead. So I think this is where my edge and the edge of many technical analysts comes to the fore, where we are able to anticipate events which fundamentally is not possible to envisage. Likewise, we are at the top of the Dow Jones, and everything in US economy suggests that the market is going to continue higher. Nothing to suggest it's going to go anywhere but up, and yet the charts are suggesting that the market is probably run out of steam or is very close to running out of its steam. It's certainly not going to continue higher for another 6 months or 12 months. We won't see the economy reflecting that maybe for another 6 months, 8 months, maybe another 12 months before we'll begin to see fundamentally profits are declining, unemployment rate is going up again, and all the other things that you'd expect to see probably won't be seen for many few months ahead, maybe another 6 months, maybe 8 months, maybe 12 months from now. If the equity market begins to collapse very quickly, whilst the fundamental might not support that immediately, many will begin to sniff that there is some problem here, because they were not expecting this kind of weakness in the equity market, and maybe they'll begin to revisit their fundamental analysis and might begin to revise things, but nevertheless they will be not able to suddenly adopt a bearish attitude. So they might temper their bullishness or expectation of economy improving. They might find reasons why we've had a bit of setback, but still be expecting a bullish resolution. That would be my view. Time will tell. But based on Nikkei index, I am suggesting that the US dollar yen for the currency traders is going to be weakening substantially. I am already marking out around about 90 as the minimum, maybe at worst retest the bottom of the range of US dollar yen. But I'm quite happy that if it gets to about 90 area on a US dollar yen, it will still fulfill my expectation. And what we might have there is that the Nikkei index will make a new low, but the US dollar yen will refuse to confirm the low, and it will then set me off with what I call, with a related market, set me off with what I call a divergence. So talking about divergence and the implication of Nikkei index, because many of you might not necessarily be trading Nikkei index, but I think it's a big window into what's coming ahead on a wider equity market, and possibly wider financial instruments, either positively correlated or negatively correlated, is the chart of Nikkei index itself plotted against, if I can get to the correct chart. Before we go into that, let me just point out the way we were topping out here. This spike high you see is in a May, but this high here is end of 2013, which is where I think we have topped. And you can see the similarity of my analysis with major wave counts being applied on this weekly chart of Nikkei index, and confirmation that we have already made a first impulsive decline as a wave 1 or an A. Then subsequently we have gone back into this minor A, minor B and minor C, giving me either as a wave 2. So if this is wave 1, this is wave 2, and will be dropping down strongly in a wave 3, or this could be wave, a larger, in fact what it should be is this wave A should be in parenthesis to differentiate from the lower degree wave A in magenta, and then here should be wave B. So either this is wave 1 or an A, this is wave 2 or a B, and we should be declining very strongly in a wave C or a wave 3. So we won't know exactly until we get a bit more price action, but what I do expect out of this now is possibly a decline which would take us back to the lower level somewhere in the region, something like that, ABC, only as an outline, not necessarily. Don't say that this swing was here, so you were predicting low by exactly this time and it hasn't, so you're wrong. I don't mean to do it that way. What I am purely saying is we will get, we'll get like an A, B, C to give you larger wave A, retrace back, and then another A, B and C to give you this. So we're basically looking for zigzag, and each zigzag will have a zigzag of its own. So maybe that could be is how market will unfold, but certainly by middle of 2017, which is what we're looking at on the other chart, is when we are going to be getting this cycle degree wave 5 finish, where the Nikkei index will then experience several years of a bounce, not a new bullish cycle, because that is going to be the major problem. The Nikkei index is not going to revisit its all-time high back in 1990 for many years to come. Probably not in my lifetime, and probably not in the lifetime of many who will be viewing this over the next few months. But I will explain that in future occasion. But for the time being, this is what I'm expecting. So if Nikkei index is going to be doing this, I will now take you to this other chart where we are talking about divergence. Okay, so this is the dimension which many people will probably not take into account when they're doing analysis. So here you see Nikkei index plotted from 1990, and so is the Dow Jones. And I have drawn these vertical lines where there are significant highs and lows in Nikkei index and possibly in Dow Jones. Nikkei index is plotted as it is, like a normal, not a log scale, simply because for the period we are looking at, there isn't a significant change in terms of percentages like we've seen on a Dow Jones from 1980 to here. So Dow Jones have converted it to log chart, because if I don't, then some of the finer points here can't even be noticed. You can see it's sort of, well, you can see just about, but it's not so pronounced. So it's better on a log chart. Okay, so what I'm trying to point out on here is we are expecting the Nikkei index starting from here. So on my other chart that I showed, you'll see that this was a big capital wave A. Okay, big capital wave A. Then this one here was a big capital wave B, and now what we're expecting is this big capital wave C to end over here. And normally the Elliott wave theory has, now once you go to wave A, which was the 5 wave, by the way, we know that because we looked at it from this chart here, 1, 2, 3, 4 and 5. So because of that, we know that we've had a 5 wave decline to wave A. Then we had this messy move to wave B high here back in 2000, and then we've got this 1, 2, 3, 4 we've just finished. Now we are going down to wave 5, and based on that time symmetry, we're expecting that to be somewhere in the region of, so this is guesswork at the moment, somewhere in the region of middle of 2017, somewhere in that region here. And it's not so important, other than it's a big milestone. So when we have some more price action, we will be able to refine both exactly where the wave is going to end and possibly in terms of time when it's going to end. But based on the time symmetry that I just showed you here, we are looking for somewhere low sometime in 2017, maybe middle maybe a little bit earlier on. See, if you look at this one was in November, this low in middle of middle of the year, around May. So it's possible middle of the year, but that's, as I say, it's not the focal point of what we are looking at. If get back to my chart again correctly. Okay, so back to this chart. So what the major point I want to drive out of this is, during the time when the market was rising here, we know from this other chart that the Nikkei index topped back in 1990. Okay, so since 1990, Nikkei index has been staircasing down in a sort of, if I do a quick little thing, not to the scale but just as an idea, then Nikkei index been coming down into 5 waves like that. Okay, so it finished here, 5 waves, where this wave A is complete. That's where we 5 wave finished. So it was something in this order, but it's sort of 5 waves coming to the bottom here. So when we came to 5 waves down, the Western world, or the Dow Jones, was moving up very strongly. Now normally you would expect some degree of generally when the market is rising, that means people are willing to take extra risk for their money, for the return. They are willing to invest by taking extra risk. But when the market is falling, they are less able or willing to take the risk. So just following that concept, you would expect them, because they're both measurement of risk, of people willingness to take risk, so you would expect their degree of some symmetry, some not symmetry but correlation between the two. So we can't do exact correlation over here, but if we did have the price history both for Dow Jones and for Nikkei index, we might have seen the correlation that I'm talking about. However, when you do correlation analysis, what is not reasonable is that you can't say Nikkei index been falling all the way down, so if they was correlated, why did the Dow Jones continue to higher up? So there the correlation don't stand. That's not the point of correlation. Correlation means that the market move up and down together. However, what you could have is sometimes you might see market moving up on one instrument, moving up very strong like that, coming down, retracing partially, and then moving up very strongly. But equally on the other instrument, you might have the same correlation, but you might find actually come down, doesn't retrace as much, like here, and actually come down, right, when this one drops. So what you might find is they are correlated, they are still moving up and down together, but not necessarily making the higher highs and higher lows together. So in some market you might find one of them is making higher high and the other one might be making lower highs. But whilst you're moving together, there are sometimes lag. Sometimes one leads, the other one follows by period of few months, sometimes several months. But nevertheless, generally speaking, when one is rising, you'd expect the other one to be rising. When one is falling, you expect the other one to be falling. But their respective highs and lows are not exactly identical. They have their own respective highs and lows. So one market could be in a bullish, long-term bullish cycle, other ones could be in a long-time bearish cycle, but nevertheless they will move up and down together. So if you just understand that aspect of correlation, that they don't have to be posting all-time highs together and all-time lows together. That's not the point of correlation study. Correlation study is to see how they behave. So if you take up the picture now from this wave A, so we've had a market rising very strongly all the way, right? So if you were to take the view of a correlation, you would be saying that during this period this market just went sideways, right? So let me just change the color of that one to show you that we make it green, and we make that one bold, and we make it like that. So my correlation study will be telling me that here Japanese index, broadly speaking, just went sideways during that period, but the Dow Jones made significant progress to the upside. Now so based on correlation, I would be thinking to myself that is telling me there's a major problem. Major problem, because what needs to happen is, if this market went up and it made a partial retracement, this one just simply went sideways, and then when this market goes up, I would expect this one to either break out from this range with this resistance. So the Nikkei index should have really broken out from 22,600 area to the upside along with Dow Jones, or Nikkei index is only going sideways and this one is going up, means that there is a major negative bearish divergence developing, which has lasted for several years, from 1990 when the market topped. From 1990 to 2000, that's a 10-year. So for 10-year, Nikkei index dropped, Dow Jones went up, and then from this period, particularly from this period, when Nikkei index made a wave A low, we made a low here, and this Dow Jones went up, Nikkei index simply went sideways. So Nikkei index really did not confirm this bullish move of Dow Jones. So there is what I call divergence developing. So now what I would expect is, in order for this Dow Jones to retrace and continue higher, what Nikkei index should have done, should have come back to the base as a support, and it should have broken out. Then they would have both confirmed each other. Here they are divergence because the Nikkei index is so weak, even though Dow Jones has gone up to the top. So that's a big mega divergence. But within the chart here, you see there are minor cycle degrees of divergences, i.e. we had Nikkei index make a top in 1996 and make a lower top in 1997. So it's a 12-month apart, make a lower top, whereas the Dow Jones made higher high. So then we had a situation where Nikkei index made a low, significant low, whereas the Dow Jones only went sideways effectively. So there was another minor divergence. So Nikkei was showing weakness, Dow Jones was just going sideways. When the Nikkei index, then we had a situation where Dow Jones went up, Nikkei index went up together. They both went up together. However, Dow Jones topped out first, we know at the beginning of 2000, and the Nikkei index did not top until April 2000. So there we had almost what we call 5-6 months of divergence developing. So once we done that, then we had Nikkei index continue to fall, Dow Jones fell, but then Dow Jones bottomed out in September 2003, whereas the Nikkei index did not bottom out until April 2003. Dow Jones bottomed in September 2002, Nikkei index bottomed in April 2003, and then they both went up together. Then again we have at the top where we had Nikkei index top out first, Dow Jones top out afterward. Coming back to the down, the Nikkei index made double bottom, with the first bottom being formed in October 2008, Dow Jones making lower lows and actually bottoming out in March. So in all degree you see at a major turning point there are 3-4 months, 5-6 months warning when one of them tops out or bottoms out of that particular cycle and the other one then follows, or one leads and the other one follows, right? So here now we have Nikkei index topping out, as we know, at the end of 2013 rather, and the Dow Jones only made a small retracement, went on to make a new higher high, and the Nikkei index is actually making lower high. So now we have, in this cycle degree, we have a divergence. In this big massive cycle we also have a major divergence, i.e. the Nikkei index, broadly speaking, from here just simply went sideways, whereas the Dow Jones had made higher high all the way. So now if we begin to go down, we would possibly be looking for a major weakness in Dow Jones to correspond with that. So we could be, if this one is coming back to September 2009 low, we could be looking for low of Dow Jones in September 2000, or rather in March 2009 being retested. So the correlation between Dow Jones and Nikkei is very high positively, and when you ignore the fact that you don't expect them both to be making higher and higher lows same time, but you're expecting to compare the actual swings, then Nikkei index is expected to come back and retest 2009 low. So by implication, we are expecting, sorry, I'm keeping saying September, but it's really March 2009 low. So we're expecting Nikkei index to do that. We're expecting Dow Jones likewise to come back and retest the March 2009 low. So with that in mind, we can now see in our mind's eye where things are going. For the next 12, certainly 18 to 24 months, we know we could be in a major bearish cycle, even though at the moment it might appear almost impossible, illogical, and contrary to all the bullish fundamental news that might be coming out of Japan and US and many other wider developed economies of the world. The question then is, and to bring it to conclusion, is how do you plan to benefit from this? So the benefit from this would be is that if you are long in your investment in equities, either through pension fund or through whatever other investments, then you should seriously be considering the future prospect, and looking for taking defensive measures, whether that means you have stop losses in place or whether you begin to start taking some profit for at least a significant retracement, even if you don't share my bearish view of coming back down to March 2009, is to simply expect a major retracement. But for the time being, you will be avoiding the loss that was suffered by investors during this decline and this decline. Secondly, if you are more experienced trader, then you might even be possibly looking for ways to capitalize on this decline, i.e. make money on the way the market is declining. Not so easily done. Shorting any basic market carries high risk. Like trading any instrument is very high risk, but particularly shorting market could be extremely risky. But there are ways of doing this based on your analysis and your conviction. You can begin to then develop trading strategies. My proposition is trading using options to help you define the risk that is acceptable to yourself, and then longer term actually benefiting by using options to gain from the major market cycle directional move one way or the other. So in this case, a bearish move, and there will be other markets which will be negatively correlated, which will be moving to the upside. So by pinpointing potential opportunities in these markets, you could significantly benefit from either a long directional trade or a bearish directional trade, or at least by limiting the potential losses by taking profit, and certainly having stop losses in place, so that should it trigger, that you will be willing to move into cash as a means of safety, and wait for the market to bottom out or the storm to pass, with a view of maybe re-entering at some safe point in the future. So that is my analysis, my approach. I have gone on for long, but I think the material I have delivered is probably the best of my technical analysis ability. Really something that I think I'm giving out, and I hope that many of you will benefit from this. And this is the first video that I'm putting out this year for my major cycle call, just like the one that I highlighted on a YouTube available, which I used to outline my major bullish call back in September 2012. But this time around, I personally aim to capitalize from the directional call I'm putting out right at the beginning of the turning window. And I am also in the process of developing a private trading group who will have a benefit of learning this big time technical analysis, applying various strategies to capitalize on it, and certainly trying this out on a demo trading account until they feel confident to be able to use that for their personal live trading. But I think the opportunity being presented is so big that correctly used can be very, very profitable, and certainly if not actively traded, then be beneficial in terms of limiting the losses. But the second video that I'll be putting out next week, I'm not sure whether that will be on the basis of recording or live video, is we'll be looking at possible concept of trading this and taking advantage of this with the view of having a formal option trading group that I just mentioned, private group. It will not be available for wider community, but people who join me for a shorter time window, who will be allowed to come into this trading group for paid subscription, where you will have opportunity of exploring many different types of trades where they could be traded safely or considered trading safely, using options to limit your losses, limit your exposure, and trading these big swings rather than worrying about week to week, because many of you like me may have other responsibilities, either working full-time or family responsibilities, or really do not have the time or prefer to be sat in front of the PC monitoring intraday price charts, where a lot of random noise might be evident, although even then it's not random, but could appear random, but taking advantage from big swings, and which is where major institutions and wealth managers create big money. They create big money in capitalizing on big swing like that, rather than trading small little squiggles and month to month. So I hope to share those ideas and possibilities with a small group of traders, and I call them small group because, as I say, it will be relatively small, but it will also be small because I will only be limiting that for a period of time for people to join me, after which that particular membership will be closed, and in my website that I'm launching, there will be other services available for people subsequently to consider subscribing for, but they will not be anything like what I'm delivering and propose and plan to deliver through this private trading group, based on the use of this big time analysis and by means of using options as a trading instruments. So it's something for you to learn and hope to gather adequate skill and then apply these in your own trading to grow your wealth. But if not, then I certainly thank you for taking your time and hope it will help you in other ways, maybe to use this as a means of leveraging your own skill of technical analysis based on your particular approach, to refine that and use it in whatever means you see fit. So thank you for your time. Hope it's been profitable and beneficial, and would welcome your constructive criticism, suggestions or observations, or appreciation by means of the email that I outlined at trading charts for wealth at gmail.com, or info at danv-charting.com, or here on the trading view, when maybe you might be able to post me a comment, direct comment, either on my published charts or using private messages. So this is where I will close the recording. I will upload it then subsequently onto a YouTube, and hope that many of you will benefit from the material that I presented here.